upcoming financial market crisis, crash, and chaos. Before we move on, I would like to implore you to please help our channel grow by subscribing to our channel, please. Thank you. The upcoming financial market crisis, crash, and chaos. The next financial market crisis, crash, and chaos is never going to be like the great 2008 financial crash. The collapse of both Silicon Valley Bank and Credit Suisse are common events, although now contained. Although both are badly run banks that are ripe for a fall, both banks are plagued with events like squandering investors' faith. Regulators had let problems fester for a long time. Quick and aggressive actions by both the Swiss and American authorities rapidly energized the crisis. Nevertheless, the runs on these banks are better seen as symptoms of an underlying disease that continues to fester. Before the 2008 crash, the West had experienced a long period that came to be called the Great Moderation. The neoliberal model, so widely adopted in the post-Cold War era, had substituted fiscal for monetary policy as the prime lever of economic management, diminishing the role of politicians in favor of central banks. Over 3 decades, a mix of steady growth, short and shallow recessions, rising wealth, and tame inflation was lionized by economists as their profession's triumph. The ordinary man in the ordinary bus on the way to the city center has always discovered that there was something fishy in this plastic economic boom. The steady inflation underpinning it actually owed less to clever macroeconomic management than to the return of China and the deeper integration of developing countries into the world economy. The economic boom and its globalization was the biggest migration in human history, as billions of people left their farms for the burgeoning cities of the developing and developed world. This swelled the global labor pool by several orders of magnitude, luring a tide of investment away from the developed countries as firms sought cheap labor, making companies in Western countries boomed in profits, but the resultant job market did not boom at all. So when the crash happened in 2008 all through to the year 2009 and more, there was a moment when it seemed the model might come in for profound change. Cheap labor meant cheap money. Although inflation is kept low by cheap labor costs, central and national banks were free to flood the markets with money, inflating asset values and thereby creating a wealth effect that boosted demand sufficiently to bring the economy out of recession, preventing depression, bringing the economy back on its feet, making national governments and authorities all over the world celebrating the boom with pongs and parties. However, when the model in which the rich got richer and everyone else got poorer is nothing to be right home about, and the decade which followed the crash produced increase in protest, populism, and anti-establishment politics on both right and left, this political revolt had its financial analog in Bitcoin, which exploited cheap money policies to produce assets which, by having their supply fixed, could only rise in value. Grassroots financial innovation exposed national banks and central banks all over the world as painting a picture that is not the real case. The national banks and central banks all over the world did not care much about the numerous protests all over the world about their economy. The more recent one is the protest on the hikes in taxes in countries like Kenya. One would have thought that asset price inflation might at least have come onto their radars since it was baking inflationary pressures into the economy. With the rising cost of assets falling heavily on workers who were trying to buy houses or businesses that had to pay rising rents, anything which restored the bargaining power of labor would release that pent-up demand, exacerbated by false economic pricing policies of banks and central banks of the world, but it felt to their deaf ears. However, the suppression of workers in Western countries is changing rapidly. Around the mid-decade, with the demographic transition underway across most of the developing world, the increase in the global labor supply peaked. The first signs of rising labor costs began showing up in the data of Western countries. The data presented by the above-listed points is a semblance of what happened in the early 70s, when years of steadily building inflationary pressures were sent into overdrive by the oil shocks. Similarly now, any kind of jump in prices would cause a hike in inflation all over the world. The same thing also happened during the pandemic, with numerous lockdowns, shipping closures, airlines streamlining their operations, factories closing, choked off supplies, and many more, which radically altered people's demand patterns. Suddenly, our taste and demand changed forever. We wanted more takeaways, but much less air travel. The resulting imbalances sent prices very high in certain sectors. This price hikes all over the world made central and national assume that these effect is temporary and would sort themselves out soon, but they were wrong. Inflation did not settle back down of its own accord, and they forgot to change their monetary policy, which may correct this anomaly. Central and national banks all over the world failed to understand that the altered conditions in labor markets meant that this time around workers were in a better position to bargain for pay increases. Across developed economies, wages shook off their decades-long funk and began rising, and to cope, employers had no choice but to raise prices of wages. Once this became apparent, central banks had no option but to change tactics, by which point inflation was nearing double digits. They were forced to slam the brakes hard with sharp interest rates and measures to take money out of the markets. After decades of more or less handing money over to fund managers, central and national banks were now asking for their money back, which forces asset holders and fund managers to either liquidate some of their portfolios or cut their buying, knocking down asset and share prices. With the advent of social media, word spread fast that some banks no longer had enough assets to redeem everyone's deposits and savings if they all turned up at the cashier's desk, and in the event of a crash, central and national banks all over the world now find themselves trapped in a stop-start course of withdrawing money with interest rate rises and putting it back at each sign of any stress. This in turn is putting hardship on the average consumer, and first-time property ladder aspirants would dare not venture into the property market all over the world. The IMF, International Monetary Fund, the silent controllers of most countries' economy with their unique loan terms and structural adjustments prescriptions for the countries that takes out their loans, was not silent. They made series of predictions. Among their predictions were that most countries of the world will soon return to low interest rates, which may boost their economy, but this may prolong the addiction of the financial system of the cheap money syndrome, which may in turn be a circle and treadmill of returning to the same spot. The markets, currently acting as if the magic money tree is back, don't believe them. As a result, this tug-of-war will probably drag on, complicating both the battle on inflation and any efforts to fix the underlying problems in the economy. There may be a lifesaver and way out of all this complications, though. Unlike in past crashes, when owners emerged largely intact and workers took the hit, this time it looks like asset prices will remain under pressure while wages hold up high. The fall in real incomes has led everyone to take account of every individual's blessing and a change in attitude, although wages continue to rise. Who knows whether prices of goods and services may follow suit? Will it correct inflation all over the world? Only time will tell. National and central banks will have to go back to the drawing table and come up with a more robust plan to control inflation and boost their country's economy. They have to cognizance of their workers. In particular, if core inflation remains sticky, they will have to keep interest rates higher for longer. Who knows? But this may squeeze profits and further depress asset prices and may force the populace to struggle in the fight against inflation, quite a change from the last few decades. National and central banks are muddling through, with Bitcoin arguably serving as the most reliable indicator of how utterly we have lost faith in them. National and central banks indicated they are serious about inflation, wages, and prices of goods. Unless national and central banks convince everyone they are more committed to bringing down inflation than to protecting asset values, cryptocurrencies will continue to prosper. What we're thus witnessing is the end of a historic era as much as an economic one. Cryptocurrencies must be monitored, prices of goods and assets have to be controlled, and tax regime will have to be monitored closely. If economies of the world will see better days, central banks will have to take a proactive move in controlling cryptocurrencies, Ponzi schemes, and economic controls. They should use Bitcoin as an example. The more uncontrollable agents in the likes of FX, cryptocurrencies, Ponzi schemes, and other economic mechanisms and tools are allowed to stipulate interest rates. It may be a struggle to sustain economic stability. Who knows, the economic future of most countries may be bright.